Are you a Canadian business owner with passive investments inside of your corporation? Getting tired of paying up to 50% tax to the government on these investments? What if I told you there's a way to unlock your retained earnings, access them immediately, and potentially minimize your tax liability, all while securing your business's future and your family's legacy? That's the power of an immediate financing arrangement. And we're going to cover this in more detail today. Hi everyone and welcome back to our channel. I'm Gregory Rozdeba, the CEO of Dundas Life. The past decade, I've been helping Canadian business owners and professionals like you unlock powerful financial strategies. Before we jump in, make sure you like and subscribe so you never miss out on more insightful financial tips and strategies. Now let's talk about some of the challenges many successful Canadian business owners face. You've worked incredibly hard to build your business. You've generated significant profits, and you've saved some of those profits as retained earnings within your company. But here's the problem. These retained earnings, while valuable, are often sitting in relatively low-yielding investment accounts. They might be earning a modest return, but they're also subject to passive investment income rules, which can mean paying higher taxes. And when it comes time to transfer your wealth to the next generation, estate taxes take another significant bite out of your hard-earned money. Traditional ways of accessing these funds, like selling assets or taking out business loans, have the drawbacks. Selling assets could also trigger capital gains taxes. So you're essentially caught between a rock and a hard place. You need money to expand your business, but getting that money can be expensive and difficult. How can you fix this? That's where a strategy called an immediate financing arrangement, or IFA, comes in. In simple terms, an IFA is a financial strategy that allows you to use the cash value of a life insurance policy as collateral for loans. This approach offers tax-efficient growth and cash flow using participating whole life insurance. It's a type of permanent life insurance that offers both lifelong coverage and builds cash value over time. Now, an IFA combines three key elements to create this powerful financial strategy. For one, it uses a participating whole life insurance policy with a cash value component, which grows over time and provides life coverage. To access the funds, a loan or line of credit is obtained from a Canadian bank, secured by the policy's cash value. This allows individuals or businesses to access capital without using their personal funds. Additionally, an IFA leverages the tax advantages of life insurance in Canada, offering tax-deferred growth and potentially tax-free death benefits. Essentially, an IFA provides a way to unlock the value of retained earnings or personal assets without triggering immediate tax consequences or disrupting business operations. Let's walk through this process step by step so you can see exactly how an IFA works. Step 1. Funding the policy. Your holding company or you personally purchase a participating whole life insurance policy from a Canadian insurance company. At Dundas Life, we work with insurers like Manulife or Canada Life that offer policies specifically designated for IFAs, maximizing cash value accumulation within the limits set by the CRA. Step 2. Assigning the policy. Next, you assign the policy as collateral to a bank. This means the bank has a claim on the policy's cash surrender value if you were to default on the loan. It's a secure loan, which is why the terms are generally more favorable. Step 3. Accessing funds. The bank provides you with a credit facility. This could be a demand loan callable by the bank, though rare in practice, or a revolving line of credit similar to a home equity line of credit. The amount you can borrow is directly related to the policy's cash surrender value. Step 4. Annual premium deposits. Each year, your holding company or you continue to make premium payments into the policy. We provide confirmation of these deposits to the bank and they, in turn, typically increase your credit facility. It's a cycle that builds both your insurance coverage and your access to capital. Step 5. Using the funds. You can use the funds for many different purposes. However, we recommend using the funds to invest. You can invest back into your business, invest in another business, or invest in the market or real estate. So as you can see, an immediate financing arrangement offers Canadian business owners a number of benefits that access both immediate needs and long-term wealth strategies. One benefit is tax-sheltered growth, where the cash value in a whole life policy grows untaxed, allowing for faster compounding and reduced tax impact. An IFA also provides immediate liquidity, offering business owners access to capital without the need to sell assets or take out complex loans, enabling them to seize opportunities like business expansion or acquisition. Estate planning is another benefit, as the policy's death benefit can help you pay off outstanding loans and pass tax-free proceeds to beneficiaries, reducing estate taxes and ensuring a smooth transition of wealth. The use of leverage allows business owners to borrow against the policy, potentially investing at higher returns to accelerate wealth building. An IFA can consolidate various financial needs into a single, integrated strategy. Instead of managing multiple loans, investments, and insurance policies separately, the IFA provides a unified approach, potentially simplifying financial administration and reducing complexity. Finally, IFAs offer flexibility, giving business owners control over how borrowed funds are used, turning it into a dynamic strategy that evolves with your financial goals. For business owners seeking tax efficiency, liquidity, estate planning, and strategic leverage, the IFA is a powerful and flexible wealth management tool. Now, I want to be completely transparent. While an immediate financing arrangement is a powerful tool, it's not a one-size-fits-all solution. One of the primary risks is complexity. IFAs require careful planning and execution, and it's important to work with a qualified advisor who understands the intricacies of IFAs. Another risk is debt servicing. When you borrow against the cash value of your policy, you'll need to make interest payments on the loan. These costs can add up over time, so it's important that you ensure you have a plan in place to manage your debt. IFAs also require a strong financial foundation and a long-term perspective. This means you should have a stable income, a solid credit history, and a clear understanding of your financial goals. By working with an experienced advisor like one at Dundas Life, you can determine if an IFA is right for you and create a customized strategy that meets your needs. It's also important to consider the potential impact of interest rate changes to your IFA. If interest rates rise, your loan payments may increase and impact your cash flow. On the other hand, if interest rates fall, you may be able to refinance your loan at a lower rate, which could save you money. If you fail to make premium payments or borrow too much against the policy, you may risk lapsing the policy, which could result in the loss of your investment and any potential tax benefits. It's essential to work with a qualified advisor to ensure you have a plan in place to maintain your policy and avoid lapse. While the tax-sheltered growth within the policy is attractive, it's important to consider the opportunity cost of allocating funds to the IFA. Could those same funds, if invested differently, potentially generate higher returns even after considering taxes? This requires a careful comparison of your potential investment alternatives and a realistic assessment of your risk tolerance and investment time horizon. A final consideration is the potential impact of market fluctuation on your life insurance policy. If the market declines, the cash value of your policy may decrease, which could affect your ability to borrow against it. So who is an IFA right for? The ideal candidate for an immediate financing agreement is typically a successful Canadian business owner with significant retained earnings. You are looking for a tax-efficient way to deploy capital while securing substantial life insurance coverage. High net worth individuals with substantial assets and a need for significant life insurance, often for estate planning purposes, also make great candidates. Professionals with predictable incomes, such as doctors, lawyers, and dentists, who require long-term financial planning, are well suited for an IFA. Also, individual investors who have a long-term vision, understand the benefits of tax-advantaged growth, and are comfortable with the commitment involved will also find the strategy effective. However, IFAs are not a good fit for businesses with inconsistent cash flow, as the strategy requires the ability to service debt. They are also not suitable for those who need immediate access to the full cash value of their policy. Now let's bring this to life with a couple of case studies. Dr. Singh, a 38-year-old owner of a successful medical practice, has retained over $300,000 annually in his corporation after taking a salary. Finding himself in a high tax bracket, both personally and corporate, he searched for tax-efficient wealth accumulation and retirement planning strategies. Dr. Singh implemented a $2.5 million participating whole life policy with a premium of $125,000 annually for 10 years. funded through his corporate retained earnings. The 25-year projection showed impressive results, a cash value of $3.8 million, growing tax-free and a death benefit increasing to $6.1 million. That would transfer tax-free to his beneficiaries. Throughout this period, Dr. Singh strategically used policy loans to purchase commercial real estate in his practice, $800,000 in year 1, fund his children's education, $240,000 over 8 years, and make strategic investment in a medical technology startup, $400,000 in year 15. Dr. Singh also created a retirement income stream of $100,000 annually, starting at age 65, through systematic policy loans, which had no tax consequences since the loans aren't considered income. This approach provided a tax-efficient retirement plan that helped him avoid OAS clawback reductions and old age security benefits that occur when net income exceeds a certain threshold, and kept him out of a higher tax bracket in retirement. By leveraging the policy, he was able to expand his practice through real estate acquisitions with favorable loan terms while also building a substantial retirement income that wasn't tied to market performance. Next, meet Sarah, a 42-year-old manufacturing company owner generating $450,000 in annual corporate income after salaries, who had accumulated $750,000 in retained earnings within her corporation. Concerned about high passive income tax and succession planning for her children's future involvement, she purchased a $3 million participating whole life policy with a $150,000 annual premium for 8 years, funded by redirecting corporate retained earnings. Over 20 years, the strategy saved $420,000 in corporate taxes while building a tax-free cash value of $2.1 million. Sarah leveraged policy loans to expand her facility, $500,000 in year 8, purchase equipment, $250,000 in year 12, and fund her daughter's education, $120,000, repaying them on her own schedule rather than the bank's timeline. By age 62, her policy had a $5.2 million tax-free death benefit that would transfer to beneficiaries and create a capital dividend account credit for the tax-free distribution to shareholders. This strategy provided Sarah with capital control, significant tax advantages, business liquidity without requiring bank approval, and a robust succession plan allowing her children to inherit the business with sufficient capital to maintain operations or to buy other shareholders out if needed. Finally, let's address some common misconceptions about IFAs, as there can be confusion surrounding how the strategy works. One of the most frequent misconceptions is that an IFA is simply a complicated loan. In reality, it's much more than just a tool for borrowing money. An IFA is a comprehensive strategy that combines the advantages of life insurance, including tax-sheltered growth, tax-free death benefit, and leverage. Another common misconception is that IFAs are too good to be true. While IFAs can be powerful financial tools, they are not solutions for generating instant wealth. These strategies are complex and require careful planning and execution to be successful. IFAs are not designed for quick financial gains, but are intended for long-term wealth accumulation and strategic financial management. To fully benefit from an IFA, you need to approach them with a disciplined mindset and a willingness to commit to a long-term plan. There's also a misconception that IFAs are only for the ultra-wealthy. While they are often used by high net worth individuals, successful business owners, and those with substantial assets, the strategy is not exclusive for this group. The minimum premium required for an IFA can vary depending on the specific policy and the needs of the individual or business. If someone has a need for significant life insurance coverage and the financial capacity to support the strategy, an IFA may still be worth exploring. Therefore, IFAs should not be viewed as tools only for the very rich, but rather as potentially beneficial option for anyone with a long-term financial outlook. A common myth is that IFAs are inflexible and cannot be adjusted once they are implemented. However, this is not the case. IFAs can be tailored to meet your changing needs and goals, and adjustments can be made to the strategy over time. This flexibility allows you to adapt to changing circumstances. Finally, some people believe that an IFA is always a superior financing option compared to traditional loans or lines of credit. This isn't necessarily true. The suitability of an IFA depends on a complex set of factors, including your individual financial situation, risk tolerance, long-term goals, and the specific terms of the IFA versus alternate financing options. Working with a skilled insurance advisor to explore all available options is essential before deciding on an IFA. It's not a universally superior solution. Immediate financing arrangements offer Canadian business owners and investors a powerful financial tool that combines life insurance with financing opportunities. By leveraging a policy's cash value, an IFA provides immediate liquidity while preserving underlying insurance protection. A standout feature of IFAs lies in its ability to deliver tax-efficient access to funds for diverse financial needs, ranging from business expansion to other investment opportunities. However, an IFA is a complex financial strategy. Success with IFAs requires professional guidance, careful planning, and a strategic approach tailored to your individual or business needs. When executed successfully, it can offer Canadian entrepreneurs a smart approach to capital management and wealth creation. So, are you ready to explore if any immediate financing arrangement makes sense for you? If you're a Canadian business owner or a high net worth individual who fits the profile we've discussed in this video, I encourage you to click the link in the description below and book a no-obligation call with us at Dundas Life. We specialize in helping Canadians with life insurance and tax-saving strategies. And if you found this video helpful, please give it a thumbs up and don't forget to subscribe to our channel, constantly sharing valuable insights on financial planning and life insurance strategies, specifically for Canadians. Thanks for watching, take care, and we'll see you in the next video.